Welcome, seniors. As we navigate the complex world of taxes in our golden years, it's crucial to understand the various strategies available to keep more of our hard-earned money. In this comprehensive guide, we'll explore essential tax relief methods for seniors in 2024, covering everything from special deductions and credits to smart retirement account management. First, let's consider how your tax situation might have changed since retirement. As a senior, your income likely comes from various sources, each potentially taxed differently. These may include Social Security benefits, pension payments, retirement account withdrawals, investment income, and even part-time work or consulting. Understanding how each of these income sources is taxed is the first step in developing a strategy to lower your overall tax bill. It's worth noting that the IRS provides higher standard deductions for seniors aged 65 and older. For the 2024 tax year, if you're 65 or older, your standard deduction is $1,850 higher for single filers and $1,500 higher for each married spouse who is 65 or older. This means you can earn more income before it becomes taxable. When it comes to income, it's important to distinguish between taxable and non-taxable sources. Taxable income typically includes Social Security, partially depending on total income, pension payments, traditional IRA, and 401k withdrawals and investment income. Non-taxable income may include Roth IRA withdrawals if conditions are met, some life insurance proceeds, and certain types of municipal annuity. Understanding these distinctions can help you make informed decisions about your income sources and potentially lower your taxable income. And now, let's dive into specific deductions and credits that can help lower your tax bill. As we age, medical expenses often increase, and the good news is that you may be able to deduct these costs. For 2024, if your total medical expenses exceed 7.5% of your adjusted gross income, AGI, you can deduct the amount over this threshold. This includes costs like doctor visits, prescription medications, dental care, eye exams and glasses, hearing aids, long-term care insurance premiums up to certain limits, and even certain home modifications for medical reasons. Keep detailed records of all medical expenses throughout the year, as even small costs can add up. If you own your home, property taxes can be a significant expense. However, you may be able to deduct them on your federal tax return. While the Tax Cuts and Jobs Act of 2017 limited the total state and local tax, SALT, deduction to $10,000, this can still be a substantial deduction for many seniors. Some states also offer property tax relief programs specifically for seniors, so be sure to check your local options. Many seniors find fulfillment in giving back to the communities, and if you itemize your deductions, charitable contributions can also help lower your tax bill. Cash donations, donated goods, and even mileage driven for charitable purposes can be deductible. So remember to keep receipts and acknowledgement letters from the organizations you support. Here's a valuable tip. If you're over 70 and a half, you can make qualified charitable distributions, QCDS, directly from your IRA to eligible charities. This can satisfy your required minimum distribution, RMD, without increasing your taxable income. Don't overlook the credit for the elderly or disabled. If you're 65 or older, or under 65 and permanently disabled, you may qualify for this credit. The credit amount ranges from $3,750 to $7,500, depending on your filing status and income, while income limits apply. This credit can significantly reduce your tax liability if you qualify. Additionally, if you're still working part-time and contributing to a retirement account, you might be eligible for the Retirement Savings Contributions Credit, Savers Credit. This credit is worth up to 50% of your contributions to a qualified retirement account, with a maximum credit of $1,000, $2,000 if married filing jointly. Income limits apply, but it's worth checking if you qualify. Managing your retirement accounts wisely can have a big impact on your tax bill. Once you reach age 73, as of 2024, you generally must start taking required minimum distributions, RMDs, from your traditional IRAs and 401ks. Failing to take your RAM can result in a hefty 50% penalty on the amount you should have withdrawn. However, there are strategies to manage RMDs effectively, such as considering Roth conversions before RMDs kick in, using QCDs to satisfy RMDs and support charities, or delaying RMDs from your current employer's 401k if you're still working. Converting some of your traditional IRA to a Roth IRA can be a powerful tax strategy, especially in lower income years. While you'll pay taxes on the converted amount now, future withdrawals from the Roth IRA will be tax-free. This can be particularly beneficial if you expect to be in a higher tax bracket in the future. Consider spreading conversions over several years to manage the tax impact. The order in which you withdraw from your retirement accounts can also impact your tax bill. A general strategy might look like this. Take RMDs first. If applicable, withdraw from taxable accounts. Tap into tax-deferred accounts, traditional IRAs, 401(k)s, and use Roth IRA funds last. This approach can help manage your tax bracket and preserve tax-free growth in your Roth accounts. Social Security is a crucial income source for many seniors, but it can also impact your tax situation. Depending on your total income, up to 85% of your Social Security benefits may be taxable. If your combined income, adjusted gross income non-taxable interest, a half of Social Security benefits, is between $25,000 and $34,000, single, or $32,000 and $44,000. Married filing jointly, up to 50% of your benefits may be taxable. If your combined income exceeds $34,000, single, or $44,000, married filing jointly, up to 85% of your benefits may be taxable. To potentially reduce the taxable portion of your Social Security benefits, consider managing your withdrawals from retirement accounts to stay under income thresholds. Consider Roth conversions before you start claiming Social Security, and utilize tax-free income sources like municipal bonds or Roth IRA distributions. While we focus primarily on federal taxes, don't forget about state-level tax breaks. Many states offer additional tax relief for seniors. Some states like Florida, Texas, and Nevada have no state income tax, which can be beneficial for retirees. Others, like Pennsylvania and Mississippi, don't tax distributions from 401(k)s, IRAs, or pensions. Many states offer increased standard deductions or exemptions for taxpayers over a certain age, while some provide property tax relief by freezing assessments for seniors or offering homestead exemption off. A few states even exempt seniors from paying sales tax on certain items like groceries or prescription drugs. Be sure to research the specific tax breaks available in your state or any state you're considering for retirement. Before we conclude, let's cover a few more valuable tips to help you keep more of your hard-earned money. If your itemized deductions are close to the standard deduction amount, consider bunching deductions into alternate years. For example, you might make 2 years' worth of charitable contributions in 1 year, allowing you to itemize that year and take the standard deduction the next. Qualified longevity annuity contracts, QLACs, allow you to defer a portion of your required minimum distributions to a later age, potentially reducing your current tax bill. You can invest up to $200,000 or 25% of your retirement account balance, whichever is less, in a QLAC, delaying distributions until as late as age 85. If you're enrolled in a high-deductible health plan, a health savings account, SA, can be a powerful tax-saving tool. HSAs offer a triple tax advantage. Contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. After age 65, you can withdraw HSA funds for non-medical expenses without penalty, though you'll pay income tax on these withdrawals. If you're looking to reduce your taxable estate, consider taking advantage of the annual gift tax exclusion. For 2024, you can give up to $18,000 per person, $36,000 for married couples, to as many individuals as you like without incurring gift tax or using your lifetime inquiry. While we've covered a lot of ground, tax laws are complex and constantly changing. Consider working with a tax professional who specializes in senior tax issues. A good tax professional can help you identify all applicable deductions and credits, develop a long-term tax strategy, stay compliant with tax laws, and potentially save more than their fee in tax savings.